so that they can help their exports. It all starts with the growth divide. Okay, so you're going to hear all this rhetoric that I just sort of outlined to you during the entire course of the year. Okay, you're going to hear these terms used all the time. And really just remember that the question now for 2011 is, can we straddle that? As a globe, can we still get global recovery going, or are we going to make a big policy mistake in China and stop Chinese growth? Think of what happens to the world's growth picture if only the $5 trillion economy, not the $15 trillion economy, doesn't grow at 10%, doesn't generate $500 billion, but only grows at 2 or 3 or 4%. That not only hurts China, that hurts Germany, that hurts the United States. So this global growth divide is really critical that we somehow manage a way to straddle it. And basically from here, I want to just give you the key forecasts that we made for 2011. I'm not going to read these to you, but I would say to you that the top one, top two, and top three are really the key ones. First is that we can somehow straddle this global growth divide. We feel the U.S. will accelerate faster, I'll talk about that in a minute, and significantly faster than most are expecting, and we hope that Europe holds together. There's going to be a whole lot of epoxy to do that, but we think Europe holds together. Now there are risks to these, and I'm just going to tick off a few of those. If any one of these forecasts does not come to pass, it probably does not undo the recovery. If 2 or 3 of them combine, if Europe goes south and the United States stalls out, for example, that probably does undo our forecast. I want to give you a couple of examples about number one, and this is tolerating that global growth divide. I mentioned that Europe is in trouble. Their banking system is in trouble. The European officials decided that they needed to raise a lot of money to show the world that the European Union had all these cash reserves, that they could stem any run on the banks or stem any run on the government so that investors wouldn't be scared. Everybody with me? So they said they needed to raise about $800 billion to $1 trillion of reserves for the European Union to have some confidence that they could keep everything together and send a really strong message to the world. They couldn't raise it. They couldn't get enough member countries to kick in that kind of money. So they said to the world, who's interested in helping us out here? And guess who stepped forward with $200 billion? China. And right after China did it, guess who stepped in with $100 billion? Japan. Why? Because guess who China's biggest trading partner is? You think it's the United States? It's the European Union. Now it's 18 countries versus 1, not a fair comparison, but nonetheless that region is a bigger trading partner for China than the U.S. is. We're the biggest single country, but that's the biggest single region. Okay? So guess what? If the euro unwinds, guess who gets hurt? So now we all think maybe China's just full of themselves and full of self-interest and they're running around with their chest puffed out. It's not the case. They recognize that this global recovery is very important to them, and that's why we think this global divide will be bridged. You get things like that going on. Here's one more example to tie the U.S. into this. The United States went to a meeting in South Korea, in Seoul, in the fall of 2010 called the G20 meeting. Ever hear of it? All the top 20 countries, they met in Seoul, Korea, maybe you remember it. The U.S. went with one key objective. They wanted to leave there, from a country viewpoint, they wanted to leave there with a free trade agreement with South Korea, joining the other 17 countries with whom we have free trade agreements. And they publicly said, we've got this deal basically iced. We've talked to South Korea, they want it, we want it, we're going to get this done. They didn't get it done. And the administration came home very embarrassed with no free trade agreement signed with South Korea, which, by the way, is a very productive economy. So, a few months later, fast forward to about December, early January, North Korea launches a military fusillade of attack onto a small South Korean island. Civilians are killed, some military personnel are killed. South Korea picks up the phone. I'm now this is sort of reality TV, me thinking this through. They call the U.S. and say, you know, how would you like to come over and do some joint naval military exercises off of our coastline to show North Korea that we are good buddies? And the U.S. says, we're there. We go over and we create this enormous naval armada that goes off the coast of China, off the coast of South Korea. Less than 30 days later, guess what we signed? The free trade agreement. My point is, you're going to hear a lot of rhetoric. Watch the actions. You're going to hear a lot of, U.S., you're cheapening the dollar. China, you're keeping your currency too high. Brazil, you're imposing tariffs that shouldn't be there. Brazil, you're imposing capital controls, trying to prevent foreign investment from coming in here. You're going to hear all that rhetoric. Watch the action. They're not that stupid. They know they need to have the global economy continue to recover. We still, like, this is where you would have liked me to start. What's the 5 stocks and let's get out of here. Okay, recap of 2010. First of all, I'll let you know we had about $85 per share of profit in corporate America as measured by the S&P in 2010. Not quite finalized yet. Here are the forecasts from low to high, and these are no longer representative of low to high, by the way. Low to high, that's still probably the low point. The midpoint is now around 98, and the high point is around $105 to $110 a share of earnings from 85. So we've got like $10 to $15 of gain over 85 in terms of what people are expecting earnings to come through for next year. Now the question is, well, what would you pay for an economy or a stock market that's going to get that kind of price gain in terms of earnings? And the question is, what price would you pay for that earnings? And normally the stock market pays about $15 in stock price per share for every dollar of profit, 15 to 1 kind of leverage. At the bottom of the stock market in 2009, it was down about 9 to 10 times earnings. And there's a little plus and minus here, 13 times. So we're just going to take 13 and multiply it times 90, 15 and multiply it times 90, and create each row across doing that for the S&P 500. And here's 100, which is now probably 105 or 180, much more common. Let's just take the middle column, which is sort of the normal price to earnings ratio that we see, 15 for every dollar of profit. That would put the S&P at 1,500. Now you probably don't know the S&P. Everybody knows the Dow, and nobody knows what the S&P number. The S&P is right around 1,300 right now. I'm not an accountant, so I'll call that 1,300. 1,300, subtract that from 1,500. Everybody with me? Get $200, 200 gain, right? On a 1,300 base, you've got a nice 15% return. That's why we think stocks are attractive. Earnings are there. Prices aren't all that expensive. Opportunity is really good. Corporations have 6 quarters now getting double-digit sales gain. So they've reduced costs dramatically. Now they've had a year and a half of sales growing between 10 and 11% a quarter, every quarter. So sales are way up, and that's why we think the economy will recover faster, because corporations eventually are going to start literally having to hire people. That's going to be down the road. Okay, non-U.S. stocks are also attractive. Here are things that a lot of people don't know. Look at the earnings growth rate for these countries outside the United States. Exclude Germany for a minute. Look at China, India, Brazil. We're talking earnings in their corporate side. Nobody knows these numbers. Think of the fun you can have at a cocktail party explaining this. Really, I always like to have a term that I can isolate myself very quickly from any social gathering, and mine is heteroskedasticity. I like to read on the planes. I don't like to chat to the person next to me. And so if somebody says, hey, what do you do? I say, I'm an expert in heteroskedasticity, and I can read for hours. It's a very fancy term. It just means random. Okay? So, now the question is, you now know that these countries are going to get 15 to 20% earnings projected for 2011. What a lot of people don't know, even to a greater degree, is what price earnings multiple do they pay outside the United States. And everybody thinks China stocks are very expensive to come to the United States. Actually, the Chinese stocks are cheaper in terms of price per dollar of profit than the United States market. And many of the emerging markets have that same characteristic. So, U.S. stocks we think are attractive. What would we do within U.S. stocks? We like to give you some very specific ideas. Last year we favored small companies and emerging markets. This year we're moving to large U.S. companies, primarily because they get a lot of their earnings from outside the United States, taking advantage of the high end of that growth divide. So we like those. They get sometimes 55, 60% of their earnings from outside the U.S., and they're selling a little cheaper than the general stock market. The general stock market's at 15 times earnings. These companies are about 13. We still like emerging markets. They haven't started the year very well, but we think it's more a buying opportunity than it is something more serious. And we still like small cap stocks as well. The large cap stocks have already started to buy as acquisitions a lot of the smaller companies. And if you want kind of a maverick play that nobody's really talking about, think about European stocks. You're going to do something like that, you probably do it through a mutual fund or maybe an exchange-traded vehicle. But Germany, for example, some of the companies in France and the UK, there are some tremendous opportunities. And the bad news in Europe probably can't get much worse. So any surprises that we get, hopefully, we tend to get more surprises to the upside than we would to the downside. Fixed income markets, this was the story for the last 3 years. If